Welcome to Talk Tickers. Today, we're diving into Ibotta's third quarter earnings. And wow, it was a rough one. Management's talking about a big long-term pivot, but the market? Well, the market just delivered a swift and brutal verdict on what's happening right now.
Yeah, you're seeing that right. Down almost 24% in one day. That's not just a bad reaction, that's a complete collapse in confidence. So what on earth happened? Let's get into it. Okay, so when you first look at the headline numbers, they were kind of all over the map. A little confusing, right? You had some beats, you had some misses, and it really forced investors to dig a little deeper to figure out what was actually going on with the fundamentals. So here's the table. You can see revenue came in just a hair above what analysts were expecting. But, and this is a huge but, look at that year-over-year change. Down 16%. That's a big drop in the top line, and that's the kind of number that just sets off alarm bells everywhere.
And the whole earnings per share thing, it just made things even muddier. You had the official GAAP number looking like a beat, but then the adjusted number, well, depending on who you asked, it looked like a miss. It created a lot of noise, for sure. But honestly, the smart money, they looked right past all that. They were focused on the real problem. Profitability was just falling off a cliff.
And this is the chart that tells the story. This is the real heart of the problem. Adjusted EBITDA margins, just look at that. They got sliced in half, cut right in half, from over 40% last year down to just 20%. This isn't just about revenue slowing down. This is about the core profitability of the business getting absolutely crushed.
So what's management's story here? How are they explaining this? Well, it's the classic short-term pain for long-term gain argument. They're telling investors, look, we know this hurts now, but we're doing it on purpose to build a stronger, more defensible company for the future.
And what is that future? It all comes down to this one thing, a new product called LiveLift. They are basically betting the entire company on this. The whole idea is to go from being just a simple coupon app to, a really sophisticated AI marketing platform that can actually prove its ROI to these big CPG brands. This is it. This is the bull case.
So what's the catch? Well, the CEO himself, Brian Leach, basically admitted that this new model is a huge pain for their clients to adopt. He literally said their theme for 2026, that's a year away, is going to be make it easy. I mean, that's a pretty open admission that right now it's anything but easy. It's too complex.
And of course, they're trying to pull off this massive, complicated pivot at what is pretty much the worst possible time. You've got a shaky economy, consumer brands are tightening their budgets, and they're dealing with their own internal mess from a huge sales team reorganization. I mean, it's a textbook perfect storm of headwinds.
All right, so the quarter was bad. We've established that. But honestly, it was the guidance, what they said about the next quarter, that really poured gasoline on the fire. This is what took a bad day and turned it into an absolute disaster for the stock. Just look at their forecast for Q4. It was not good. At the midpoint, they're guiding for another 16% drop in revenue. Another one, and worse, the profitability, that adjusted EBITDA, is also way below what the street was hoping for. It basically confirms that the margin collapse we saw, yeah, that's not a one-time thing. It's the new reality for now. But this was the knockout punch. Management went a step further and basically told everyone to brace for another revenue decline heading into the first quarter of 2026. They just completely blew up everyone's models and sent a crystal clear message: this pain is not going away anytime soon.
All right, so after all that, where do we go from here? That's the big question, right? Is this company fundamentally broken, or is this a massive overreaction and a huge turnaround opportunity? Let's get into our take.
So first off, let's see what the pros on Wall Street are saying. And, well, it's pretty clear. The sentiment is just terrible. You've got 90% of analysts saying either hold or sell. The message from the street is basically, stay away.
Look, the path back for Ibotta is pretty straightforward, but it's not going to be easy. It is a long road. Step one, they just have to stop the bleeding on revenue, period. Until they do that, nobody is going to care about their fancy new platform or their long-term story. This has become a show-me story, and it's going to take multiple quarters, maybe even years, to win back trust. And let's be honest, the market is not known for its patience.
So when we put all the pieces together, we're slapping a market perform rating on this one. The long-term idea, it's plausible, it's interesting, but the short-term mess, the uncertainty, the execution problems, the weak economy, it's just way too much to overlook right now.
So for our prediction, we think this stock is officially in the penalty box. It's probably just going to chop around in this range, between $22 and $28, until there's clear, undeniable proof that the revenue decline is stopped. Until we see that, any pop in the stock is likely just going to get sold right back down.
And that brings us to our outrageous but plausible trade idea. Look, this stock moves, and it moves big on earnings day. We're talking 20, 30, even 40% swings. So instead of trying to guess which way it's going to go, up or down, why not just bet that it's going to move a lot? An options play called a strangle lets you do just that. You buy both a put and a call, and you're basically betting on pure chaos, in either direction.
And as always, we have to close with our standard disclaimer. This is not financial advice.